Imagine running on a treadmill that speeds up every single year, just to stay in the exact same place. The mainstream media calls this a strong economy, but your grocery bill tells a different story. Here is the cold hard number they do not want you to focus on. 156%. That is where the Congressional Budget Office projects U.S. debt is heading by 2055. This is not just a government statistic. It is a mortgage taken out on your future labor without your consent. We are taught that inflation is a natural disaster like a hurricane. But what if it is actually a policy? What if the Federal Reserve, the institution designed to put out the financial fires, is actually the arsonist holding the match? Today we peel back the layers of the machine. Welcome to the history of your money. Before we dissect the corpse of the American economy, we need to agree on the murder weapon. Most people look at the price of milk or gas rising and call that inflation. But that is a lie. That is just the symptom. In this investigation, we are using the definition provided by the Austrian economists. Inflation is not prices going up. Inflation is the artificial increase of the money supply. Let's be brutally honest about what this is. If you print a $100 bill in your basement to pay your bills, you go to prison for counterfeiting. Why? Because you are stealing value from everyone else holding dollars. But when the Federal Reserve does it, they call it monetary policy. It is by definition legal counterfeiting. You need to understand that the Federal Reserve is not a government agency in the way you think of the DMV or the post office. It is a unique hybrid, a system with private ownership elements that operates independently to manage the state's currency. And it possesses a power that no business on earth has. The power to create money ex nihilo out of nothing. They type a number into a computer, and billions of dollars are born. But here is the catch. When they print $1 trillion, they do not create $1 trillion of value. They take $1 trillion worth of purchasing power from the existing pool, from your savings account, your paycheck, and your retirement fund. This is why the rich get richer and you get poorer. The system is not broken. It is working exactly as designed. The massive debt we see, that 156% of GDP looming in the future, is not a mistake. It is the fuel the engine runs on. The state needs this mechanism to spend money it does not have, without taxing you directly. To understand how a banking cartel got the exclusive license to counterfeit, we have to travel back to the scene of the crime, to a secret meeting that changed history. It was the year 1913 when the ink finally dried on the Federal Reserve Act, but the blueprint for this heist was drafted over 2 centuries earlier. To understand the motive, we must look at 1694 and the birth of the Bank of England. The problem facing the British Crown was ancient. They wanted to fund expensive wars and global expansion, but they had a pesky limitation: taxes. High taxes lead to angry citizens, and eventually guillotines. The solution was a stroke of dark genius called central banking. Imagine a partnership where the state gets a credit card with no limit, and a small group of private bankers gets a government-enforced monopoly to print the money that pays the bill. This arrangement turned the national currency from a simple tool for trade into a sophisticated instrument of empire. Fast forward to a secret meeting in 1910 at Jekyll Island, Georgia, where the American version of this machine of the state was finalized. The public was told this new Federal Reserve would provide stability. That was the marketing brochure. The reality is that central banking was built to decouple government spending from the physical reality of tax revenue and gold. It allowed the state to spend into infinity while the bankers collected interest on every dollar created from thin air. It was never about your financial security. It was about ensuring the government never had to hear the word no when it wanted to spend. Once this machine was bolted into the heart of the American economy, the lever was pulled. But for this engine to run at full speed, it needed a specific type of fuel, and that fuel is the very thing currently eroding your life savings. To see how the trap actually works, we have to look at the heart of the machine, the manipulation of interest rates. Imagine interest rates are like the price of time. In a natural market, they reflect how much people have actually saved. But the Federal Reserve does not believe in nature. They believe in control. The first mechanism is the creation of a fake boom. The Fed artificially suppresses interest rates, making money feel cheap and abundant. This sends a false signal to the entire economy. It is like a drug that makes every entrepreneur feel like a genius. They start massive projects, luxury condos, speculative tech startups, and high-risk crypto platforms that should not exist because there are no real savings to back them up. This is the malinvestment phase, a period of collective hallucination where the numbers on the screen go up, but the foundation of the house is built on sand. But eventually the high wears off and the withdrawal begins. Reality is a stubborn thing. When the Fed realizes that the inflation they created is spiraling out of control, they are forced to hike rates. Suddenly those billion-dollar projects aren't profitable anymore. The bust is not a random tragedy. It is the economy's attempt to heal itself by liquidating the garbage investments created during the boom. Yet the Fed views this healing process as a disease, and rushes to save the market with even more printed money. This leads us to the most sinister part of the game, the Cantillon effect. Money is not injected into the system equally. When the Fed prints trillions to rescue the economy, they don't mail a check to your front door first. The new money goes to the primary dealers, the massive Wall Street banks, the government, and the politically connected elite. These insiders get to spend the fresh cash at yesterday's prices, before the rest of the world knows it exists. They buy up the real estate, the stocks, And the gold. By the time that money trickles down to your paycheck in the form of a measly raise, the price of everything you need to survive has already doubled. This is why the wealth gap widens every time there is a crisis. The system is designed to transfer wealth from the productive class to the political class under the guise of an emergency. This isn't just theory, it is a crime that has been committed repeatedly throughout the 20th century. If you think this sounds like a dark conspiracy theory, then the history books have a few confessions you need to hear. Let's look at the crime scene of 1929. The common myth is that the free market simply broke. The reality is far more damning. While the Federal Reserve was created to prevent panics, economists like Milton Friedman proved they actually engineered the Great Contraction by choking off the money supply. In 2002, the Fed's own chairman Ben Bernanke stood before the world and admitted it, stating regarding the Great Depression, by choking off the money supply, "You're right, we did it, we're very sorry, but thanks to you, we won't do it again." But they did do it again. Fast forward to the 2008 financial crisis. After the dot-com bubble burst, the Fed slashed interest rates to an artificial low of 1%, essentially pouring gasoline on the housing market. They literally blew the bubble they claimed to be fighting. When the music stopped, they didn't let the malinvestment clear out. Instead, they introduced a toxic moral hazard by bailing out the very institutions that gambled with your future. They taught Wall Street a simple lesson. Heads, the bankers win. Tails, the taxpayer loses. The most recent evidence is still fresh in your bank account. During the 2020 pandemic, the Fed embarked on a printing spree so aggressive it created 40% of all US dollars in existence in just 24 months. They flooded the system with digital cash, kept rates at zero, and then acted shocked when inflation hit a 40-year high of 9.1%. These aren't accidents. They are the recurring patterns of a system that thrives on crisis. But we are moving past mere repetition into something far more dangerous. History isn't just repeating itself anymore. It is compounding into a debt spiral that no one, not even the Fed, can stop. In the past, the Federal Reserve acted as the lender of last resort for banks. Today, the stakes have evolved into something far more predatory. They are now the lender of last resort for the entire United States government. We have transitioned from bailing out Wall Street firms to bailing out the sovereign debt market itself. The scale of this escalation is staggering. According to the Congressional Budget Office, the interest payments on our national debt are on a trajectory to exceed the entire United States defense budget. By 2055, net interest costs alone are projected to jump to 5.4% of our total GDP. This is where the mathematical trap snaps shut. The Fed is now caught in a checkmate scenario of its own making. If they raise interest rates to fight the very inflation they created, the interest on the national debt becomes so expensive that the US government faces functional bankruptcy. But if they lower rates to save the government's budget and keep the debt manageable, they must print more money, which causes the dollar to collapse in purchasing power. They are effectively choosing between a debt crisis or a currency crisis. There is no soft landing when you are carrying over $30 trillion in baggage. This isn't just a failure of policy, it is the natural evolution of a system built on the illusion of infinite credit. And while these numbers seem like abstract macroeconomics discussed in marble buildings, they lead to one very real, very painful place, your kitchen table. You might wonder why, despite your promotions and hard work, a $100,000 salary in today's world feels like $50,000 felt just a decade ago. This is the financial anxiety you feel every time you look at your bank account. It is the psychological weight of knowing that you are running on a treadmill, where the speed is controlled by the Federal Reserve. By the time you reach your savings goals, the goalposts have been moved by another trillion-dollar injection into the banking system. The truth is, you are being forced to save in a currency that acts like a melting ice cube. Because the system is designed to lose value every year, you can no longer simply work, save, and retire. The Fed's manipulation of interest rates has destroyed the traditional saver. Today, you are forced to become a gambler just to survive. You are pushed into volatile stock markets, speculative crypto projects, or houses you cannot actually afford, not because you want to be a trader, but because it is the only way to outrun the inflation destroying your purchasing power. This is the ultimate malinvestment, the theft of your time. You spend your life chasing asset prices that rise faster than your wages because the system is rigged to reward those who own assets and punish those who earn a salary. You are not behind because of your choices. You are being pushed back by a system that requires your purchasing power to be sacrificed so the debt spiral can continue. This machine does not exist because of an accident or an oversight. It exists because it is the most efficient way to keep the elite in power. The question is no longer whether the system is fair. We already know it isn't. The question is what happens when the machine finally runs out of road. And here is the point of no return. We have to stop looking for a secret cabal of evil men in a dark room and start looking at the cold, hard math of the system they built. The Federal Reserve cannot simply stop printing, and the government cannot simply stop borrowing. If the music stops, the entire global financial structure built on the illusion of infinite growth collapses instantly. This is no longer a matter of political debate. It is a mathematical certainty. The national debt has reached a level where it can never be paid back with honest money. There are only two ways out: an overt default that destroys the banking system, or the hidden default where they inflate the debt away by destroying the value of the currency. History shows that the state always chooses the latter. They will pay back the debt with dollars that buy nothing. The debt is too high to be settled with taxes, so it will be settled with your purchasing power. The question is not will the system fail, but who will be left holding the bill when it does. As we look toward 2026 and beyond, the answer is already written in the numbers. The United States is on a collision course with a mathematical reality that no amount of political rhetoric can hide. A 156% debt to GDP ratio is no longer just a prediction from a government office. It is a sentence for the American middle class. The Federal Reserve promised a world of economic stability, but the audit of history reveals a much darker verdict. They have delivered a system where the booms are artificial, the busts are engineered, and your life savings are the designated collateral damage. We are entering a volatile period where the financial rules of the last 40 years no longer apply. The era of easy money is reaching its terminal phase, and the bill for this century-long experiment is finally coming due. History has proven that in times of systemic collapse, knowledge is the only hedge more valuable than gold. We will continue to decode this machine piece by piece in our next dossier. If you want to understand which specific assets have historically survived when the dollar falters, type 1" in the comments below. Subscribe to Financial Money History, because in this system, what you don't know is costing you everything.